Morning, everybody. Was with Instagram this morning, but I think we even have Instagram Live, Facebook check, LinkedIn check, YouTube checked, X check, Instagram check. How's everybody doing? Here we are, November 19th, 2024, episode 302 of Welcome to Mornings with Scott, the best damn business show for medium and small businesses on the planet. Walmart. Where are we here? Yeah, we're good. Walmart reported tremendous growth in same-store sales yesterday and increased their guidance for future revenue, future earnings. So we've all seen that news in the financial press, but what you did not see probably was some commentary during the earnings call that told us that the cohorts are changing. What the hell does that mean? The cohorts are changing. Basically, to sum it up, the low-income people are, hey, Ashley on Facebook, thanks for checking in. The low-income people are not buying very much at Walmart anymore, and sales are in fact down. But the high-income people, the $150,000 dollar annual earnings type people have moved from higher end retailers to Walmart. And so they're in trouble. They're feeling the pinch of inflation, and they're now shopping at Walmart, which is great for Walmart, but not a good sign for the entire economy. Hey, those of you looking for module 3 of the course, this is the business course that's available at scottsinclair.com. There is a link in the notes to this show. Module 3, I had a bit of a technical problem, but it should be out next week, certainly by the end of the month. So we will meet our 1 a month deadline here, and this is a good module. No doubt about that. I was playing around last night. Somebody sent me a link on Notebook LM. Have you checked out this let's see if I get my camera a bit straight here. Have you checked out this Notebook LM? So I don't think there's an app. I think it's just on the web. So go check that out. Notebook LM, and it's an AI platform. I think it was free. I don't think I paid for this one. And one of the things, I don't know everything that it does yet, but one of the things that it did for sure is I said, hey, Notebook LM, why don't you research my kids' school in my small town here? Here's a link. Here's on Perplexity, sort of the notes that it tells you about it. And so within about 60 seconds, it generated a 3.5-minute, more or less, podcast about my kids' school. And it's all artificially generated, and so it has a male voice, it has a female voice, and they're having a discussion in casual language about, oh, in this small town, imagine going to school where you see all these Rocky Mountains or whatever mountains in the background. They're not Rockies in the background, and it just went on and on for about 3.5 minutes. My kid was fascinated by the podcast. It was a scary and very interesting conversation. I don't know. I'm going to play with that more and see where that technology goes. But all of that to say that this may be my last podcast. Maybe I'm just going to be ousted by automation. What's the point anymore? No, I'm just kidding. I'm kidding. I have a theory. I'll tell you why I'm kidding, because we may think this is serious. I had to think about this for quite a while. But here's what I think. I think that AI will never replace human creativity. That's my theory. AI, stamp it. AI will never replace human creativity. Why is that, you ask? Well, I don't know what spark there is in humanity that's related to creativity. I don't know what the connection is between us. I don't know what AI is missing, but I do know this. Can you ever imagine yourself going to a comedy show where the star comedian is an Optimus robot? Do you think that's going to happen? Or are you going to go to a concert by a AI-generated cellist in a robot form? That's just not going to happen. You don't care. I don't care. You don't care. AI, humanity, well, I'm not saying I can't create art. I'm just saying it's missing something, and humanity won't care. And therefore, podcasts, the good ones that are not dribble, are going to be human generated. That's my theory. You should stamp it. By the way, I was looking for this Notebook LM yesterday, and I downloaded the wrong app and paid for it, of course, for a year, not just a month. AI Notebook I downloaded, so I was going to delete it and reverse the subscription last night because you got 3-day trial or whatever, and then I researched what this thing does and what it says. I'm going to play with this later today or tonight. It says that you can upload entire legal documents, credit facilities, leases, anything you want, textbooks into this app. You just attach the file and it gives you a written summary. Reads the whole thing and gives you a written summary, which the Chat GPT is not good at. So I'm excited to play with that one. AI is going to be terrific. It's already terrific at making things more streamlined, easier, more productive at work, but it's not going to replace creativity. That's going to fall to humans. Wall Street Journal reports that building products distributor QXO makes a bid for Beacon Roofing. QXO, a new player in building products distribution, has made an offer to acquire Beacon Roofing Supplies, according to people familiar with the matter. Beacon has a market value of about $6.2 billion. Its stock was up on the news. Of course, Beacon, by the way, I was interested in this because they are a former customer of ours at Sinclair Range. We had a wholly owned roofing subsidiary before I was sick about a year and a half ago or whenever that was, and we exited that business and shut it down. It was just a small business. It wasn't contributing one way or another to the firm, although we had some good people and some good hopes for that business. But anyways, Beacon Products, Beacon was both a Canadian and U.S. customer of ours. So what they do is they primarily serve contractors. So think roofing contractors, and they offer a range of commercial and residential roofing materials, siding, windows, decking, insulation, especially lumber, waterproofing, air barrier systems. And they have 530 locations across the U.S. and Canada. And it's, so, as I said, supports contractors on the job site with immediate local access to these business supplies. So this QXO, a deal could be clinched before, according to the Wall Street Journal, could be clinched before year end. They don't know the exact terms. Beacon is the largest publicly traded distributor of roofing materials across U.S. and Canada, according to the website. I think ABC is larger technically, but whatever. QXO, which is based in Connecticut, has a market value of $6.5 billion. So QXO, here's where we're heading with some of this. QXO has no business. They are a shell. I mean, they have some revenue reported. I'm not sure where that's coming from, but they have a $6.5 billion valuation. It's headed by a fellow named Brad Jacobs, who has built multi-billion-dollar companies in logistics and other sectors through acquisitions. Think roll-ups. We're going to talk about some roll-ups today. The company, which has yet to strike its first deal in the building material space, has since raised $4 billion in 2 private placements. So it's raised, he puts in $1 billion of his own, acquires a little software company, renames it QXO. If I didn't read that already, I think that comes up later in the article, and then raises $4 billion in 2 private placements. One of them from Jared Kushner, who's married to Trump's daughter, and he sits on the QXO board. QXO has been bulking up his executive ranks too. He's got the former global head of mergers and acquisitions from Barclays Bank as CFO, and Jacobs has told the Wall Street Journal that he plans QXO to grow to $50 billion in revenue over the next decade. QXO earlier this year has been eyeing a deal for Paris-listed Rexel, but that deal fell apart. And this Jacobs guy, the promoter of this, has previously built transportation and logistics companies, XPO. He likes these little these letters for the names of his company just to confuse us all. So QXO is the current one, but he's built one before where he acquired dozens of deals and split them into 3 public companies. That's where he got the $1 billion, one would think, to launch this thing. So let's talk about roll-ups. What is this? A corporate roll-up is a strategic approach where a company acquires and consolidates multiple smaller businesses within the same industry. So you acquire it and you consolidate. So what does that mean? Okay, so you start with a shell, and that could be a small business in an industrial sector that you want to consolidate, or it could just be like a public company. It could be a new public company that's entirely clean, as they say in the industry, like a SPAC in the US, CCPC. I think that program still exists in Canada. So you have this platform, and then you go and you find a private company to say, hey, I want to buy you. We're going to roll up this industry. Here's some cash. Here's some equity. And you you buy this company, you vend it into your platform, and then you go off to find the next one. And so that's what a corporate roll up is. And if you think about fragmented industries, like I was looking at it for, well, not me, everybody on the face of the earth who's related to the space of cannabis was looking at roll-ups in the US and Canada, and for various reasons, because it's not a global industry, cannabis at this point. It's a fragmented local jurisdiction, licensing, regulatory environment. And so it's not a good, it's hard to execute on roll-ups, but that's what a roll-up is. So you're taking this platform company, whether that be a clean public company or old public company, like in the tech boom, in the tech bubble around the late 90s, 2000, everybody was buying old mining public companies. So the mines were dead. There was no business. The shares were just at pennies or fractions of pennies. And they would buy these shells and they get rid of the public companies. They get rid of the mining assets. And then they go buy a tech business, a new website back then, or what have you, and the value of the public company would explode as a result. And then when the tech bubble burst and mining was hot, they took those same companies and got rid of the tech business and started buying mining companies and did roll-ups into that. So this QXO is a roll-up strategy. And I know that a week or two ago, when we last spoke, because I was traveling for a week, that we were going to talk about roll-up. So I thought this was a good opportunity to do that. Now, why might you do a roll-up, by the way? Well, there's a couple of reasons. From a value perspective, it says in the literature, when you look at roll-ups, is economies of scale. But what you should really think about is synergies, meaning cost reductions. You don't have to buy. So, for example, if you have company A, company B, and you merge them together, and they're both private companies, well, you don't need two controllers, so you can cut that cost. You may not need two head offices, you can cut that cost. So as you roll in these companies, you're paying for current cash flow, right? Because you're buying that cash flow, but you as a buyer can increase that cash flow because you don't need the overhead. Also, you can reduce competition, right? As you consolidate the industry, you can build brand as you become larger and larger. You can reduce, and this is an important one. So I think some of the important ones are namely getting rid of the redundant costs of the overheads, but you can also reduce the risk of your cash flow, which, as I've explained before on this show, is increasing your multiple, right? So the multiple is the inverse of a discount rate. A discount rate is your risk. So as your risk goes down, the multiple goes up, right? Because they're inverse, and that's really good. So basically, if I could buy a small private business at, say, 4 times EBITDA multiple and do a roll-up strategy and then sell my larger company later at an 8, 10, 12 times multiple, I've made a real profit there because I was buying at a 4 multiple and selling at an 8, 10, 12 multiple. Okay. Understand that makes sense. So, and not only that, but I've increased the cash flow, right? If I buy a business that has $3 million of EBITDA, once I own it, maybe it has 4 million in EBITDA because I got rid of some redundant overheads, plus my multiple increased. And so that's one of the benefits, the economic benefits of a roll-up strategy. And of course, a larger business has better access to capital. So that's what roll-ups are. I asked the robot ChatGPT this morning for some just historical examples, like waste management was created through a roll-up strategy in the 70s and 80s, where they acquired hundreds of smaller waste disposal companies in the United States. AutoNation is another one. The car dealership in the 1990s, Wayne Huizinga, that's where he made most of his money. Used a roll-up strategy to consolidate a highly fragmented auto dealership industry. And always be broke. Thanks for joining us on X. A great example of this is Dental Corp. Yes, it is. Where dental offices were blah altogether $1 billion. Yeah, exactly. So that's what a roll-up strategy is, just so you understand, as an investor, as a business owner. If you're stuck in an industry that just seems fragmented and going nowhere, M&A can create value, and that's what this is. The other reason I like this story is that it made me think about something I think about all the time, which is the constant struggle and alliances between manufacturing, or amongst manufacturing, distribution, value-added services, and the end user, and primarily manufacturers. So if you're an entrepreneur and you're creating a product, what is your relationship with distribution going to be? Now, this story, of course, of QXO is in the roofing industry. The roofing industry is shockingly large if you've never had any experience with it. As I said, we owned a roofing company that made tools, and I was once at a trade show in Texas somewhere. I don't remember if it was Dallas or where I was, and I went to this huge international trade show, and I was shocked by the size of it, and I was shocked by the whole center of this trade show. Because there's normally little booths and people are hawking their wares and doing whatever, but it was Berkshire Hathaway. One of Warren Buffett's companies just had this massive display, and I believe it was a roofing materials supplier. I don't recall what it did exactly, but I do remember I was like, oh wow, Berkshire Hathaway is in the roofing business. Who knew? And it's massive. It just dominated that trade show. And of course, as you wander the floor of the show, you see people that have created products, like entrepreneurs. You would see manufacturers. You would see distributors, retailers of these products, like the Beacons of the world. And you would see roofers, right? Service providers. When I say a roofer being a service provider, what's a roofer really doing is they're going out and they're doing the contracting work by buying the materials from the distributor, adding some value, and making sure they're installed. So as a product maker, as a manufacturer, as an entrepreneur, you could wander this floor and you could see so many cool, technologically advanced, new type products, machines, tools, roofing products that do this or do that, like coatings for industrial roofs that would just keep the moisture out and extend the life of the roof for long periods of time. And they have zero distribution associated with them, because these entrepreneurs didn't understand or even think about distribution. They were just building the next better mousetrap, so to speak. And so as an entrepreneur, the lesson for us as a business owner, and this article got me thinking about that, is you always need to figure out your distribution. Distribution is one of the 4 Ps of your marketing strategy, which is an old school way to think about marketing strategy, but it's very important. And so one of the lessons in this troubled roofing company that I had bought, Sinclair Range had bought, is we had no idea, management had no idea back in the early days about the difference between sell in and sell through. So in the distribution, so we create cool roofing products, tools specifically, and then you sell to, say, Home Depot, and you have a $300,000 order, and you ship them a bunch of product, and you think, hey, I made a $300,000 sale. But that is a failing to understand the distribution channel, because what that is called a sell in. That's how much product I'm selling to that particular retailer or distribution partner. What I'm not focused on is sell through, which is how much Home Depot is selling of those tools uh, to roofers, to end use customers in that particular case. And if you don't understand the difference between sell in and sell through, you're screwed, because all Home Depot cares about is the sell through. How much are they selling? What margins are they getting? Do they have no headaches? Is it worth their floor space or shelf space to buy your product and put it there? Is it turning quick enough? And the responsibility for that, a lot of entrepreneurs think is totally on Home Depot in our hypothetical, or not so hypothetical in my case, example. But it's not. It's not. The manufacturer, the entrepreneur themselves need to help the Home Depots of the world, the distribution partner, actually sell the stuff. Okay. And so that's the difference between sell in and sell through. Take responsibility. When you're a manufacturer, you can't just, and you are an entrepreneur and you're creating new products, you can't just have this mindset that I will build it and they will come. We just see that so often. Take responsibility for understanding and working on your distribution plan. The power in many industries is often in distribution. Same with financial products, right? By the way, let's say you want to start a fund, and what's the first thing you need to do? Well, you need to manufacture the product. You think that's a weird thing to say, Scott? It's the financial industry. There's no manufacturing. Well, that's what we call it in that business. So you manufacture the fund. Here's the structure. It's going to be a hedge fund structure or an opportunities fund. It's going to be an LP, GP structure. The fees are going to be like a 1.5% management fee and then 20% success fee on the upside with a high watermark. So you got to go through all of that. You got to do the documentation. You got to put everything in place. But then who the hell is going to buy your fund? That's the distribution part. And you need to go out to the funds that fund funds, right? Like bigger pension funds, sovereign wealth funds, whatever, to the banks, to the wealth management firms. But all of them already have their favorite manufacturers that they work with, and many of them, like the wealth management firms, actually have in-house, and the investment banks already have in-house product that's sort of white labeled. Like we have our own fund. Like, why would I invest in your fund? So if you don't think ahead and have a distribution partner, you're just going to spend a bunch of time and money and spin your wheels. Just checking on comments here. Speaking of not understanding distribution, this story is 2 years old, a couple of days old, not 2 years. Where did I get that from? A couple of days old, and I'm not sure where I picked it up, but I liked it, and it related to not understanding your distribution. The Trudeau government here in Canada had a $9 million bet on edible crickets. I can't even talk this morning. $90 million bet on edible crickets, and it runs into trouble. Now, who would have thought about that? Just 2 years after the Trudeau government put up nearly $9 million to help build the world's largest edible cricket factory, the facility is dramatically cutting staff and retooling. Aspire Food Group Inc. has a 150,000 square foot edible cricket factory in London, Ontario. For those of you that don't know, London, Ontario is 2 hours west of Toronto, and it's laid off 2/3 of its workforce to make some improvements to its manufacturing systems. I don't even want to know what the manufacturing processing system is for a cricket. Like, ugh, ugh. This is despite very generous grants from the Trudeau government. The grants created this factory built by Aspire as the world's largest cricket production facility. The factory was to house 4 billion crickets at any one time and churn out 13 million kilograms of edible crickets each year. Aspire's signature pitch, one of the is that crickets have a lower environmental footprint than meat or dairy. And so everybody bought into this. This was part of the woke culture, is we have to stop eating meat. We can't get our protein from beef anymore. We have to get it from insects, and crickets are a good way to do that. Aspire says, quote, high volumes of nutritious food with a low environmental footprint. And, quote, meet global demand for food by using less water, energy, and space, and emitting significantly less greenhouse gas emissions. This is why you should eat crickets. I'm not going to do it. I'm not going to eat the crickets, but you, Ashley, and Always Be Broke, for example, can go out there and have some crickets. In September 22, Aspire announced an agreement with the Korean food distributor. Here we go. So they're creating a cricket product for consumption. They need a distribution partner. So with Korean food distributor Lot, L-O-T-T-E, Confectionery Co. Limited, pitching it as their first deal to sell cricket power for human consumption. However, the deal was only a MOU, a memorandum of understanding. That's where you write down the terms of what a deal might be, but it's not really a deal. You're just like, it's non-binding. You're just trying to, it's like documenting a discussion to, quote, formalize their cooperation and distribution and promotion of crickets as food, end quote. And according to Ag Funder News story, the mass layoffs and productions that they announced, the mass layoffs and production slowdowns, said the facility was in fact not selling crickets for food. It was just shipping them to pet food manufacturers in turn, because it turns out the only one that wants to eat your cricket is a dog. That's what's happening here. I don't know. I hope they disclose that on the ingredients list. I think it's even disgusting for my dog. Here's the point. You spend a bunch of money, the government invests in the plant, and what happens? There is no distribution because no one wants their product and no one thought about distribution before spending all the money. Distribution very often has the power. A bunch of comments here. Hard pass on insect bites. Thanks. Wouldn't want to live near 4 billion crickets. I think that's exactly right. That's just shocking for the people of London. No one seems to be terribly excited about the cricket idea, which I think is the point. Okay, I'm running out of time. I'm going to skip the I have a story about oil and regulation. Maybe we'll get that tomorrow, and we will just focus on distribution today. Remember, it has power in most sectors of the economy. Not all, but most sectors of the raise your hand if you most sectors of the economy. But as a counterpoint to that, I just want to leave you with a final thought from Naval, the super smart tech investor. You can check him out, and philosopher. You can check him out on X with the handle at Naval, Naval. He says networking is overrated. I completely agree. People always say to me, hey, can you raise money because of your network or this and that? And I say, no, it doesn't I mean, yes, I could raise some money, but it's not because of the network. What it's because of is the product. Networking is overrated. Go do something great and it will come naturally. That is advice from Naval. Quote, I would say to startups, don't spend your time in meetings unless you really have to. I truly think networking is overrated. There are all these articles about how you have to network, and they make me want to vomit. Go do something great, and your network will emerge naturally. 100% agree. Do something great, and your network, your distribution will emerge naturally. In many industries, distribution has the power, but in this idea of networking, of human connection, doing something great is maybe a product that cannot be ignored. There's many great manufacturers that are not, create products that are not tied to somebody else's distribution. Apple, for example, just handled their own distribution right away. And you'll see many other examples of that in the tech world where you have world-beating products, truly unique products, and they decide to go direct to consumer. For example, a friend of the show, what is that sock company called? Rob Fraser, you can look it up. He's great on LinkedIn and other social media. Outweigh branded socks out of Victoria, a great entrepreneur who's doing very well for himself. He has no distribution, third-party distribution. He goes direct to consumer. That is a way to take control of your distribution. All of that to say, understand the distribution in the industry that you are going into and have a strategy. Have a strategy to deal with that. That's it for today. We will see you tomorrow. I believe I'll be here all week, with the exception of Friday when I'm on a plane during this time. Thank you, everybody, for joining and commenting. We will see you tomorrow, 8:30 Mountain. Beef, butter, bacon, and eggs. Go Cardies. Yeah, exactly. All right, guys. Thanks. Talk to you tomorrow.